One of the big questions I always get asked is what does a financial or what should a financial analysis look like? So initially I want to give you just an overview of that. What does this actually financial analysis look like? And we'll go into more detail in further videos. So the financial analysis itself is really a review of any statements that you've been provided. And as you're doing that, make sure you take note of any large changes. You also should include comparisons, historical comparison, industry comparisons. And again, this will depend on the information that you have available to you and what that looks like. And then you want to model the solution, talking about the assumptions you made along the way. Generally, it should be focused on profit, but also consider the revenues and the costs and how they work together. And you want to also use measures that match the organization's maturity. And then the last piece is really to put together a bit of a sensitivity analysis of the forecasted numbers so you can build expected, a worst, best case type of scenarios as you go along. The situational analysis is really about looking at the existing financial statements to find the big changes and using ratios and such to compare the firm on a relative basis on things like profitability, solvency, cash conversion cycles, value, etc. So really breaking it down and getting your understanding in terms of what does the situation financially look like. And then you can start to compare historically to industry using ratios, and there are other types of calculation comparisons that you can use. Remember, there's three types of analysis: a horizontal, which is between 2 years; trend, which is based on 3 or more years; and vertical, which is based on the relationship within a year. And it's best to show all of those. I think it's also useful to convert statements to percent of sales, so it's easier to see the trends as you go through. On the comparative analysis side, there's things like liquidity and cash flow. So do you have enough money to pay the bills? Profitability, how much money is being made? Stability, how stable are the organization's finances? Where the growth is it in profits? Is it in revenue? Is it in equity? Is it in assets? Is it in something else? And then efficiency, in terms of how well is that organization using and managing its assets or its money. And so getting a good idea in terms of where that's coming and compare that to their competitors. One note I want to make is compound annual growth rate, or CAGR. Remember, it's representational. It smooths out a growth, or if you're losing growth, you're declining, it smooths out that curve. So you may want a CAGR plus. You may also look at it in terms of what happens from year to year on that basis. It's good for comparisons. And it can be done with things other than just profit: investment, sales, customer satisfaction. There's a whole number of things that you can build a CAGR for. When you start to create the model, it's about estimating the revenues and costs based on the financial and industry benchmarks. You want to make sure the scale matches the size of the event or the organization. Is big enough for the audience you're targeting. And the same thing on the impact side. The impact is big enough. It's going to make enough of a difference that your audience, or who you've identified as your audience, should actually listen to you. In terms of financial measures, we'll go into this in further detail down the road in a few other videos. But profitability measures include things like ROI, NPV, break-even or payback periods. On the cost side, and I think this is really important to remember, there's incremental costs, there's one-time costs, there's ongoing costs, and make sure that you break those costs up into those categories so they fully understand what's going to happen in terms of the cost as your solution goes along. And then revenue, in terms of what's the percentage increase. You can also maybe look at this in terms of cost or profitability, depending upon what you're doing. And it's best to show this in a visual type of format. So on the side here, we have a graph that shows the profit with the impact, the assumptions they've made going along the way to get this, and then where it aligns. So it's aligning with a whole bunch of things that's happening in terms of ESG measures that the company that this concerns is concerned about. You also need to do a sensitivity analysis. So in this case, an expected, a best, a worst. What do they all look like? You can present, here's what it should look like, but also be prepared. It may be a little bit less, it may be a little bit more. And I think in terms of the mitigation, when it comes to the risk of mitigation, you want to talk about how do you mitigate for the worst case? How do you mitigate for the best case? Being really successful is a risk, and you need to be able to tell your client in terms of how do you also work with that. If you're really successful, there's some issues that may come along, and this is how you deal with them. And that's the advantage of doing a sensitivity analysis.